Hello there. So today I want to tell you the precautions before you start trading, and they are so important for beginners, irrespective of whether you trade stocks or forex. So the first thing is spread. Spread here, as you can see, this thing is so risky. If you don't know this thing, you may end up losing your money. So spread is a way that a certain broker, maybe your broker does not have this spread, but if your broker has this spread, they make money, whether they do not give commissions or whether they do not charge commissions on their exchange. So if your broker does not charge commission, so when you decide to place a sell order, then you will be charged this price. Your sell order will be executed respective of this price, and the real price of this, let's say this forex AUD USD is right here in between, and then we have the bid price. So if you decide to place a buy order, your order will be executed respective to this bid price, and sometimes you may end up losing money. So here I have an example of an exchange that has commissions, does not have this spread. You can see it here. I will show you. So we have here, it charges commission, as you can see here. So before you enter the market, so that is an example. And for those using your phones, you can see here we have a spread, the bid price, the ask price. So while you are trading, what you have to be careful on your exchange, if you discover that your exchange has this spread thing, it is not the same always on every option you want to trade. We have a difference that they introduce there. So they may introduce there so that they discourage trading certain options, so that they do not lose a lot of money. As we can see here, we have 66 on GBP CHF, and we have the lowest one is 17. So this is the one that you cannot lose a lot of money while you enter the market immediately. But this one may be a good option only when you want to hold it for long, so that you can recover this amount of pips. And then the second mistake some people are making is trading on the bad days. You should always avoid Thursdays and Fridays, as the market is always opened on the Monday and closed on the Fridays. So we have worst days to trade stocks. As you can see here, we have Thursdays and Fridays. I also don't recommend trading on Monday, as we have a high volatility on the stocks. We can see the data on this. So we have Mondays, as you can see, the average profits of these days, and you can see Tuesday is the best day to trade stocks, and Wednesday also a better day to trade stocks. Then we have Friday, Thursday are the worst days. Also you can see Monday is not a good day, so you should also avoid those days. When we have the first day of the month, so it's a good day to trade, and then we have these other days that are not the best ones. So you have to consider that when trading, and then you have to know that also stocks behave in a similar way as forex, so you have to be very careful. Then we have, when trading forex, I also saw in this article that Mondays and Fridays are the worst days to trade. As I said, you should also avoid them. They are not the best days to trade. I have traded it, and I know why. I was trading gold and it would move very high when I usually had I had my bet that the gold will go down, but ended going up, and I would lose a lot of money. So you have to avoid Friday. Actually, if you have a good strategy to trade in those days, then I also recommend you can do it. It might work for you. Maybe you want to find a strategy that works for you and then do it. The next one is setting take profit and take loss. So some people don't set that take profit or take loss. I need to avoid it because the market will go in the opposite direction and you may have hopes that it will come back, but it might not. So stop loss will help you to get you out of that situation. Also, stop loss will also help you to get some profits. You can use a strategy we call trailing take profit, where we will show you with this one. So let's say you entered here and then you hit a buy limit or you hit a buy order. So as the price moves up, you are getting profit. Then when it happens to us in the here, you put a stop loss. Then it goes up, just starts behaving like it needs to reverse. You put a stop loss here, a stop profit here, and we call it that way. Then it goes up. Then here you put another one. Then it breaks. So you get out of the market with profit. That is a trailing stop that helps you to get you out of the market. Because if you had hopes that it will continue going up, then you could lose a lot of money because it came back here, as you can see. That is the importance of using it, and also it can save you from high liquidity of the market, especially when news arrive. And that is a situation that you have to avoid. News also, major events like news can make you kicked out of the market. So you have to be watching out for those news. Major financial news will make the markets to move very fast, and you may make a lot of profit or you may lose a lot. So you need to be careful. And then we have use of timestamps. So some people only use 1 minute candlesticks or charts. You need to train yourself to change these candles to see every part of the market. You need to see every part of it. So let me open it. This is trading view. So I can change it to 1 minute. You can see. So this is 1 minute, as you can see. So while you are using a 1 minute timestamp, you may not have an idea where the market is moving. In short, the momentum, the market. What you need to do, you can open here and then 30-minute candlestick and see whether you can spot the momentum in the market. If you cannot, then go for 1 hour. Go for 1 hour. Try to spot. You can see here we can spot a resistance level that we will not spot at the time here. Also you can spot it here, and then you may get ready to enter the market by spotting those points. Also, as we have spotted that resistance zone, what we need to do is trade against that zone. Like if we wanted to make orders here on this market, we will wait for an opportunity to make only sell orders because of that resistance. We don't want to risk because of that resistance. So that is how the charts will help you to identify the markets, to identify the momentum or the resistance, and find better entry points. Then we have slippage. So slippage on your broker, like if you want to find what your broker takes as slippage, you just need to add that the broker name, then slippage, and search on Google. We'll have them here. So you may have, I searched for IQ option and I can show you. They have a very large article that you can find slippage down in the bottom line. So according to your broker, you will take some time and go through what they say is slippage. Then a slippage, we have a point where you make an order in the market, but we have that delay. Then we have that delay that it ends up getting at a lower. Let's take an example here. Here, I decided to make an up order at this point, but at that point the price ended moving up before my order was executed. That is what we call slippage. So at sometimes the market might be moving very fast at the point where when you place an order, it takes time to be executed, and when it is executed, the market has already moved a lot, which may cause you to lose a lot of money or make a lot. It may depend with what happens in the market. So here I have what these guys think of slippage. You can see it here. I read it. Then, so slippage may make you to lose money or get money. Mostly slippage happens during major events like news. So you have to be, or major volatility times. Volatility is the time that when the market is moving a lot. You need to avoid those moments because you may end up making bad trade. Then the last thing we can talk about is leverage. So this is the mistake that I was doing most of the time. So leverage is where it is like borrowing money to trade money. Let's take an example here. So if I have 1,000 here and then I choose a leverage of $50, if I place an order here, it is like placing an order with 50,000 USD because of this leverage. So the profit that I get, it is the 1,000 profit multiplied by 50. The similar profit that I can gain using 50,000 USD while traded without leverage. So this might sound good, but it has a lot of risk, as I have experienced it. So at sometimes when we end up choosing without knowing, or you are demo, then you ended up setting this thing at 1,000 and then you forget, and because you saw an opportunity, we just tap without checking, and then at that moment, like let's say, then at that moment you will see a lot of losses. At that moment you will see a lot of losses. So that is what I say, we need to check your leverage before placing any order. We need to check it, especially when you have brokers that have it. Yeah, some brokers have it so far. You need to go to the account settings. You need to go deep to see it, to change it. So for those brokers, there's no problem. But for brokers like this, you need to always check the leverage before executing any order, because you will end up losing a lot of money. Since you have to check, depending on how you want to stay long on the market, leverage is important. That is why I say you need to check it. Let's have a look on a certain broker and see where you can see, and you can see your leverage. As you can see here, we have leverage here. Then if I want to change it, you can come here. You can see we have 3 dots here. Just up here, you can change. Then you just up here and can change the max leverage. This here, depending on your amount of capital, you can choose here. From the least risky, the more risky. And just up it will click done. Especially if you are using your MT4 MetaTrader. So that is it. Thanks for watching.